Webull stock had another tough session on Friday, falling by 74 cents or about 6.3% to close the week at $11.01 per share. That marks Webull's lowest close in several months and continues what's been a bruising stretch for growth and fintech names across the market. Friday's decline wasn't an isolated move, it was part of a broader sell-off triggered by renewed fears of a potential US-China trade war. The week ended with major indices under pressure, as investors pulled money from high-growth and tech-exposed stocks and rotated towards safer, more defensive sectors. For Webull, that macro environment has been particularly unforgiving. While the company is headquartered in New York and regulated under FINRA, its origins trace back to Chinese founders, and that link can make it more vulnerable to market fear whenever geopolitical tensions flare up. On days like Friday, perception becomes reality, and perception was that anything connected to China, even loosely, was riskier. So, what exactly happened? Why has Webull struggled in recent sessions, and what could turn things around heading into next week? Let's break it down. Friday's drop came without any major company-specific news. There was no earnings release, no regulatory filing, and no internal controversy. Instead, the selling pressure was driven largely by macro sentiment, fear, uncertainty, and shifting risk appetite. When traders hear the words tariffs and trade war, they think of economic slowdown, supply chain disruptions, and falling business confidence. Those fears ripple across asset classes. And while Webull doesn't manufacture goods or rely on cross-border exports, its association with Chinese markets can make it a psychological target when headlines turn negative. Add to that the fact that Webull trades in a high-growth sector, one where valuations tend to be forward-looking and sentiment-driven, and you have the perfect storm for short-term volatility. Investors tend to sell growth first when the macro narrative turns sour. Beyond that, there's also the technical side of things. Webull had spent several weeks hovering around $12 to $13 per share. When that range broke to the downside earlier this week, it likely triggered a wave of automated stop-loss orders and short-term liquidation. That, in turn, accelerated the selling momentum. The move down to $11.01 now puts the stock right near an important psychological and technical level. The low 11s, and potentially even the high 10s, could form a base if the market stabilizes next week. Historically, Webull has shown the ability to rebound sharply from these oversold conditions, especially when the pullbacks are more macro-driven than fundamental. Let's talk about what's actually weighing on the stock right now, and which of those factors may be temporary. The first is macro uncertainty. The renewed US-China tension narrative came roaring back this week. Discussions around tariffs, trade restrictions, and data oversight reignited old concerns about companies with any perceived exposure to China. Even though Webull's operations in the US are robust, investor psychology tends to lump it into that China-linked risk basket during periods of geopolitical stress. The second factor is valuation compression across the fintech sector. After a strong stretch earlier in the year, fintech names, from Robinhood to Sophie to Coinbase, have all cooled off. Investors are taking profits and reducing exposure to high multiple names as they prepare for potential economic softness in 2025. The third factor is profitability. Webull remains in its growth phase, reinvesting aggressively in new markets and product expansions. It's not yet profitable, and in times of market stress, investors often rotate away from companies that are still scaling rather than delivering consistent earnings. That doesn't mean the business model is broken, it simply means sentiment has shifted from risk-taking to caution. And finally, there's a lack of immediate catalysts. With earnings behind us and no major updates on expansion or partnerships, the stock is being driven almost entirely by macro forces. That can make it more volatile in the short term, since traders don't have fresh company-specific news to anchor sentiment. Now, all of that sounds heavy, but here's where things start to look interesting. When you strip away the emotion and look purely at the fundamentals, Webull's story hasn't changed. This is still one of the fastest-growing fintech platforms globally. It's expanding aggressively into the UK and Europe. It's integrating crypto trading back into its core offering, and its user base continues to rise. In its most recent quarter, Webull's revenue grew by 46% year-over-year, and trading revenue jumped more than 60%. Those are extraordinary growth figures, especially in a challenging market. That growth has been supported by a strong global rollout strategy. Webull's entry into the UK and the Netherlands opens the door to millions of new users, while its crypto relaunch diversifies its revenue base beyond equities and options trading. When crypto markets pick up again, as they seem to be doing, Webull is positioned to capture that flow. So the fundamentals remain strong. The question now is timing. When does sentiment catch up? Technically, Webull may be near exhaustion selling territory. The relative strength index has cooled sharply, which often signals that the stock is oversold. Volume has picked up on down days, suggesting capitulation among short-term traders. If Webull can stabilize above $10.80 to $11 and reclaim $12 in the next few sessions, that would suggest the market has found a floor. In other words, this could be the early stage of a base forming, the calm before a recovery. Looking ahead, several catalysts could drive a rebound. The most obvious is any sign of de-escalation in US.China trade rhetoric. If the tariff talk cools down or if diplomatic discussions resume, markets could quickly shift back into risk-on mode. In that environment, growth and fintech names like Webull often outperform on the bounce. Another key catalyst would be renewed clarity from the company itself. Any communication that reaffirms Webull's independence, compliance, and commitment to US regulatory standards would help calm investor fears. A strong statement from management about their international expansion progress or crypto trading growth could quickly reframe the narrative. And finally, macro stability, a steadier interest rate environment or any hint of a future rate cut would benefit growth stocks broadly. Lower rates increase the present value of future earnings, which is especially important for companies like Webull that are still scaling. Now let's talk long-term, because that's where the real story is. Despite short-term volatility, the structural growth opportunity for Webull is massive. The platform sits at the intersection of retail investing, global brokerage expansion, and digital asset adoption. Those three megatrends aren't going away, and Webull's ability to bridge them gives it a strategic advantage. Analysts continue to see value here. Rosenblatt Securities maintains a buy rating with a $19 price target, implying around 70% upside from current levels. That target isn't based on hype, it's based on user growth, transaction volume, and global monetization potential. And it's not unreasonable to see a pathway toward $20 in the medium term. If user growth continues, crypto trading gains traction, and market sentiment normalizes, Webull could very well re-rate higher as investors refocus on growth potential instead of macro fear. But getting there requires patience. Volatility is part of the journey for any emerging fintech. Webull's price action right now reflects macro headwinds, not company deterioration. That's an important distinction. So, how do we interpret Friday's close at 11:01? I'd describe it as a possible capitulation point, the kind of exhaustion move that often happens near a short-term bottom. The stock's sharp decline, combined with elevated volume and lack of fresh news, suggests panic selling rather than rational repricing. If support holds around $11, this could set up a snapback rally as early as next week. If not, and the stock dips into the high tens, that may represent a deeper but still healthy reset before resuming an upward trajectory. Either way, the long-term thesis remains intact. The growth story is alive. The fundamentals are strong. And sentiment, while shaky, can change quickly once the macro picture stabilizes. For long-term investors, these are the moments that test conviction. Volatile periods often shake out short-term holders but create opportunity for those who can see beyond the noise. So yes, it's been a rough couple of weeks for Webull. The $11 handle doesn't look great on the chart. But under the surface, the business remains on track. The expansion continues, the product base is diversifying, and the potential for reacceleration in the next few quarters is real. As we head into the new week, keep an eye on three things. First, the geopolitical headlines around tariffs and trade. Second, whether Webull can stabilize above that $11 level. And third, the broader sentiment across fintech and crypto markets. If we see even a modest improvement in any of those areas, this pullback could quickly flip into a recovery setup. In my view, this is more of a reset than a reversal, a chance for Webull to consolidate before resuming its broader uptrend. And for investors looking at the long-term horizon, the path to $20 remains in sight. It might take time and volatility to get there, but the fundamentals justify the optimism. Friday's pain could very well be laying the groundwork for next week's gain. Thanks for watching, and don't forget to like, comment, and subscribe for more updates on Webull and other growth stocks. Let me know what you think. Is this capitulation, or the perfect setup for a rebound? I'll see you in the next one.